EBITDA, amortization, leverage, APR, assets, liability, underwriting. You've heard these words your whole life, but let's be honest, most people can't explain them without Googling mid sentence. Now, look, this isn't a vocabulary test, this is a power shift because in finance, language isn't just a way to describe the game, the language is the game. You don't understand the terms, you pay the price, pay the hidden fees, you get the bad loan, you miss the investment, you get played. This video, this is your dictionary. Today we're going to break down 38 financial terms into plain, simple English, no textbook definitions, just the critical information you need to stop losing and start winning. So grab a notebook or open a new tab. By the end of this masterclass, you'll have the financial vocabulary most adults wish they learned in school. Now, let's get started. We're starting with section 1, the personal scoreboard. These are the numbers that define your personal financial health. Number 1, net worth. Forget your salary, forget your job title. Your real financial scoreboard is one number, your net worth. This is the simplest, most important calculation in finance. It's what you own minus what you owe. Example, if you have $20,000 in savings, a car worth $10,000, and $5,000 in student loan debt, your net worth is $25,000. This is your true financial footprint. But to calculate this, you first need to know the difference between two critical terms. Term number 2, assets. What is an asset? The simple definition is something you own, but that's not good enough. The smart definition is an asset is anything that puts money in your pocket or has the potential to grow in value. Think of assets as your financial employees. They work for you. This includes cash, stocks, a business, a home you rent out, even a skill you have that earns you money. Opposite of an asset isn't just stuff, it's a liability. That brings us to term 3, liabilities. A liability is anything that takes money out of your pocket. These are your debts and your obligations. Think of them as drains on your wealth. Credit card balances, car loans, student loans, your mortgage. The central game of building wealth is simple. Use your income to acquire assets that generate more income and minimize your liabilities that drain it. Assets feed you, liabilities drain you. Quick question, drop it in the comments. What was the first asset you ever bought on purpose? A stock, a savings bond? Let me know. Term number 4, cash flow. A person earning $200,000 a year can be poorer than a person earning $60,000 per year. How? It all comes down to cash flow. Cash flow is not your income. It's what's left over after all your expenses are paid. It's the money that moves in versus the money that moves out. Example, if you make $5,000 a month, but your rent, car payment, and lifestyle cost $5,100, you have negative cash flow. You're going broke slowly month over month. Now, if you make $4,000 and only spend $3,000, you have $1,000 in positive cash flow. You have the power to build wealth. And the best thing you can do with that positive cash flow is to put it to work using term 5, compound interest. You've probably heard that Albert Einstein called compound interest the eighth wonder of the world. It's a great line. The only problem, he almost certainly never said that. The quote is widely attributed to him, but there is zero concrete evidence he actually said those exact words. It was likely invented by an investment house copywriter as a marketing slogan. But here's the thing, it does not matter who said it. The concept is the most powerful force in finance. Compound interest is your making you money, and then that money making more money. It's a snowball rolling downhill. You invest $100, you earn 10% interest. So now you have $110. The next year, you don't just earn 10% on your original $100, you earn it on the full $110. So you get $11. Now you have $121, then $133, then $146.70. The snowball gathers mass and momentum. The powerful part of that fake quote is this. He who understands it earns it. He who doesn't pays it. When you have savings, compound interest works for you. When you have credit card debt, compound interest works against you. There's a force that eats your compound interest. It's called term 6. Inflation, it's a silent thief. It's the reason that what cost $20 10 years ago costs $30 today. It's the rate at which prices rise and the purchasing power of your money falls. If your savings account pays you 1% interest, but inflation is 3% interest, you're not making money. You're losing 2% of your buying power every single year. This is why it is so important to invest. Your money has to grow faster than inflation, or you're getting poorer just by standing still. Term 7, liquidity. How fast can you turn your stuff into cash? That's liquidity. Cash in your checking account is perfectly liquid. Stocks, ETFs, very high liquidity. You can sell them and have cash in a few days, but your house, your car, a piece of art, that part of that business you own, that's a liquid. You have to find a buyer, negotiate a price. It could take months. Wealthy people often have a high net worth but low liquidity. They're house rich, cash poor. You need a balance of both to be truly secure. Term number 8, opportunity cost. This is the most important concept in economics, and it applies to everything. It's the ghost of the road not taken. The opportunity cost is the value of the next best alternative you gave up. Every dollar you spend is a trade off. The cost of that $1,000 new phone isn't just $1,000. It's the opportunity you lost to invest that $1,000, which could have grown to $5,000 in 10 years. Think about the last big purchase you made. What was the true opportunity cost? Let me know in the comments. All right. Section 2. Let's talk about debt. If you don't understand these terms, you'll give away thousands of dollars to the bank for free. This is where they hide their fees. Term number 9, credit score. This 3-digit number is your financial resume. It's your adult GPA. Your credit score is a number ranging from 300 to 850 that tells lenders one thing: how likely are you going to pay me back? It dictates if you get approved for a loan and, more importantly, what rate you pay. A high score saves you thousands. A low score costs you a fortune. It's that simple. Term 10, interest rate. This is the headline number. It's a sticker price. An interest rate is simply the cost of borrowing money expressed as a percentage. If you borrow $10,000 at a 6% interest rate, you're agreeing to pay $600 a year for the privilege of using that money. But this number is a trap. It's not the true cost of that loan. For that, we need to look at a different number, which brings us to the most important part of the entire video. Term 11 and 12, principal and APR. I get this question all the time. Is it even possible for two loans to have the exact same 6% interest rate but have a different APR? The answer is yes. It's the most common trick in the book. First, let's define principal. That's simple. It's the original amount you borrowed, $10,000. Now, let's define APR, or annual percentage rate. The APR is the true total cost of your loan expressed as an annual percentage and includes the interest rate plus all the required fees. This can include origination fees, closing costs, mortgage insurance, and other charges depending on what type of a loan it is. Now, this isn't just financial trivia. Lenders are required by federal law to show you the APR. This law is called the Truth in Lending Act, or TILA. Before this law was enacted in 1968, lenders could advertise a super low teaser rate and then bury you in thousands of dollars of origination fees, underwriting fees, and closing costs. TILA and its implementing rule, Regulation Z, force all financial institutions to use the same credit terminology and expressions of rates. They must disclose the APR before you agree to the loan, so you can make an apples to apples comparison. Now, let's look at the APR trap. Look at this. Loan A has a 6% interest rate, but it also has $3,000 in closing costs. The lender rolls these fees into the loan. Your true cost, the APR, is actually 6.4%. Now, Loan B has a 6.2% interest rate. That looks more expensive, right? But it has no fees. Its APR is 6.2%. The loan that looked cheaper, Loan A at 6%, is actually more expensive, 6.4% APR. You'd only know this by ignoring the interest rate and comparing the APR. That is your right as a consumer, thanks to TILA. That's going to be a short, save it, share it. Never ever compare loans by the interest rate. Only compare the APR. Term number 13, amortization. Ever look at your mortgage statement and realize after 5 years you've barely made a dent in the principal? That's amortization. It's a schedule of how your loan is broken down into payments over time. Here's the catch. In the early years of a loan, like a 30-year mortgage, your payments are front loaded with interest. Most of your money goes to the bank. In the later years, the payments flip and most of it goes to your principal. That's why making one extra principal payment per year, especially early on, can shave years and tens of thousands of dollars off your loan. Term 14, secured versus unsecured debt. Why is a mortgage rate 7%, but a credit card rate is 27%? It's all about risk. A secured loan is secured by collateral. Collateral is something the bank can take if you don't pay. Your house for a mortgage or your car for an auto loan. This is lower risk for the bank, so you get a lower rate. An unsecured loan is backed by nothing but your promise and your credit score. That's your credit card, your personal loans, your student loans. It's high risk for the bank, so they charge you a massive rate. Now, you've got your debt under control. Now it's time to build wealth. This is your investor's toolkit. Term number 15, diversification. You know the saying, don't put all your eggs in one basket? In finance, that's just the starting point. The balanced plate. Think of your portfolio like your diet. If you only ate chocolate or one stock, you'd be at high risk for a crash, right? You'd be missing key nutrients. Diversification is like building a balanced plate. Spread your risk across different assets, stocks, bonds, different industries, tech, healthcare, and different geographies, US, international. One flop, one company going bankrupt, it's not going to sink your entire ship. This is the single best way to reduce risk without sacrificing long term returns. Term 16, portfolio. What's a portfolio? It's simply your collection of investments. It's your financial playlist. It's all the stocks, bonds, ETFs, and index funds you own all in one place. Your portfolio is the total garden, and the individual investments are the plants. Term 17, index fund. Do you want to beat 90% of Wall Street experts with almost zero effort? Buy an index fund. It's not a single stock, it's a basket of stocks that automatically tracks the market index like the S&P 500, which is just the 500 biggest companies in the US. Instead of trying to find the one needle in the haystack, you just buy the whole haystack. An index fund makes it easy to own a small portion of many, sometimes thousands of investments. It's simple, it's incredibly cheap, and it consistently outperforms most high paid money managers over time. Term 18, ETF, exchange traded funds. An ETF is like a cousin to an index fund. It's a fund that trades like a stock. Like an index fund, it holds a basket of assets like the S&P 500 or a basket of gold or a basket of tech stocks. But unlike an old school mutual fund, you can buy and sell it all day long, just like you would a share of Apple or Amazon. Term 19, capital gains. This is the profit you make from investing. It's really simple. You buy a stock for $1,000, you sell it for 1,500. Your capital gain is $500. Be careful, you owe taxes on that gain. If you hold the investment for less than a year, you pay high short-term capital gains tax. If you hold it for more than a year, you pay much lower long-term capital gains tax. The system is designed to reward patience. Term 20, dividends. Do you want to get paid just for owning a stock? That's the dividend. When a mature, profitable company like Coca-Cola or Apple has extra cash, it pays out a portion of its profits to you, its shareholder. It's passive income. It's your cut for being a part owner in that company. Term 21, market capitalization. This is also called market cap. This is essentially a way that you can say, hey, how big is the company? Don't look at its stock price, you look at its market cap. A $100 stock is not more expensive than a $20 stock. The price per share is irrelevant. Market cap is the total value of the entire company. It's the stock price multiplied by all the available shares. This is how you compare if a company is a large cap giant or a small cap startup. Term 22, volatility. How wild is the ride? That's volatility. The stock that swings 20% in a day is high volatility. A utility company that barely moves is low volatility. High volatility means high risk but also high opportunity. Low volatility means stability but slower growth. A good analogy for market volatility is someone riding up an escalator while playing with a yo yo. The fact that the yo yo, or the market, goes up and down doesn't prevent it from eventually reaching the next level. Now, bear market versus bull market. You hear this on the news all the time. It's simple. A bull market is when prices are rising, everybody's optimistic and greedy. Think of a bull thrusting his horns up. A bear market is when prices are falling, generally 20% or more. Everyone's pessimistic and scared. Think of a bear swiping its claws down. Amateurs get greedy in bull markets and panic sell in bear markets. Professionals do the opposite. They get cautious in bull markets and they go shopping in bear markets. Now, you've mastered the basics, you're ready for the advanced playbook. These are the terms that involve risk, but big players use them to get big returns. 24. Leverage. Leverage is using other people's money to amplify your results. Buying a $500,000 house with a $100,000 down payment is leverage. You're controlling a $500,000 asset with only $100,000 of your own money. If the house value goes up 10% to $550,000, you didn't make 10% on your money. You made $50,000 on your $100,000 investment. That's a 50% return. But leverage is a double-edged sword. If the house value falls 10%, you've lost $50,000. That's half of your down payment. Leverage amplifies gains and losses. If you can't handle the downside, you don't deserve the upside. 25. Hedging. What is hedging? The simplest analogy. It's insurance for your investments. You don't buy your car insurance to make money, you buy it to reduce the negative financial impact should an accident occur. A hedge works the exact same way. It's a second investment you make, like buying a put option that's designed to go up if your main investment goes down. Now, insurance isn't free. To get that protection, you have to pay a premium. Hedging always has a cost. A reduction in risk, therefore, almost always means a reduction in potential profits. If your main investment makes money, your hedge has cost you reducing your profit. But if your main investment loses money, your successful hedge has reduced your loss. It's not about maximizing gains, it's about minimizing loss and letting you sleep at night. Underwriting. Ever apply for a loan and wonder what the person behind the curtain is doing? They're underwriting. This is the process the bank uses to decide if you're worth the risk. They check your income, your assets, your debts, and your credit score. They're verifying everything. If a bank won't underwrite a loan for you, don't get mad, get curious. They're a professional risk assessor. If they wouldn't lend you money, you should ask yourself why. Asset allocation. This is the most important decision you'll make as an investor, more important than any stock you pick. Asset allocation is how you split your money between big categories: stocks, bonds, cash. Think of it as designing your garden plot. Stocks, the seeds you plant, are your growth engine. Bonds are for stability. Cash, that's your emergency reserve ready to be deployed. Asset allocation is a strategy. Example: 50% stocks, 40% bonds, 10% cash. Diversification is a tactic. Example: buying different types of stocks and bonds within those buckets. Your allocation is what will determine 90% of your returns. Margin. This is leverage on steroids, and it's how most amateur traders blow up their accounts. Margin is borrowing money from your broker to buy more stock. If you have $10,000, your broker might let you buy $20,000 worth of stock. If the stock goes up, gains are double. If it goes down, you get a margin call. The broker demands their money back immediately, and if you don't have it, they will force sell your stocks at the worst possible time to get their money back. It's a brutal. Do not use margin unless you are an absolute expert. Now, thinking like a CEO or a private equity investor, how do they value a business? Let's look at revenue versus profit. My local coffee shop did $1 million in sales last year. Are they rich? Maybe not. That $1 million in revenue, the top line total money that came in. But then you have to pay for coffee, beans, rent, employee salaries, and taxes. What's left over? That's profit, sometimes called net income. Never confuse activity with success. A company with $100 million in revenue and $101 million in expenses is a failure. A company with $1 million in revenue and $500,000 in profit is a success. Revenue is vanity. Profit is sanity. EBITDA. This is the scariest looking acronym in finance, but it's the one private equity firms love most. I remember I was at a workshop one time and the presenter said, "What is EBITDA?" We had a group, maybe 7 or 8 people. I was the only person that could define it. So if you're ever in a situation like that, now be the only person that could define it. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Now, why do they use it? Because it's a proxy for cash flow. It normalizes companies for comparison. It removes the noise of three things: interest from interest. It removes the impact of a company's capital structure, how it's financed, allowing a buyer to value the business independent of its debt, which can be easily changed. Taxes. It removes taxes, which can differ based on the company's legal structure or geography, making firms easier to compare. Accounting. It removes depreciation and amortization, which are non cash accounting constructs that are influenced by assumptions and not indicative of a company's ability to generate cash. By stripping all of that noise away, an investor can compare the pure operational performance of company A versus company B on a level playing field. It's a standard metric for valuing mature companies, and it is looked at as a health score of the company. It's not a perfect number, and it can be manipulated, but it's the industry standard for valuation multiples. Now, let's look at cash burn and runway. Let's talk about startups. These two terms are two sides of the same coin. Cash burn, or burn rate, is how fast a company is losing money. If a startup has $1 million in the bank but is losing $100,000 every month, its burn rate is $100,000. Runway is how long it has before it's dead. In that example, $1 million divided by a $100,000 burn rate, that company has a 10-month runway. That's how long the founders have to either become profitable or raise more money. Valuation. Simply, what is a business worth? That's its valuation. It's not always logical. It's a mix of hard numbers like profit and EBITDA and hype like growth potential, brand, and market sentiment. In private markets, valuation is often set by what an investor is willing to pay in a financing round. In public markets, it's set by the market cap. Capital structure. How does the company pay for all its stuff? That is its capital structure. Think of buying a house. Your capital structure is the mix of your equity, your down payment, and your debt, your mortgage. A company does the same. It can sell equity, shares, which dilutes ownership, or it can take on debt, issue bonds like a loan. Why would a cash rich company like Apple still take on debt? Because debt can be smarter than equity. It's tax deductible. Interest payments are usually tax deductible, which can make borrowing more attractive. It's not dilutive. Taking a loan means that owners don't have to give up more control of the company by selling more equity. The optimal capital structure is a strategic balance. Too much debt is risky. Too much equity is inefficient and dilutes the owners. So, final section. We've learned the terms for scoring, borrowing, investing, and analyzing. Now let's bring it all. This is the why. This is the strategy in life. Emergency fund. This is your financial get out of jail free card. An emergency fund is 3 to 6 months worth of your bare bones living expenses saved in a boring, liquid, high yield savings account. This is not an investment, this is insurance for your life. When your car breaks down, you lose your job, you have a medical bill, you don't have to go into credit card debt or panic sell everything at a loss. This fund is the firewall between you and financial disaster. Budgeting. I know everybody hates this word. Let's reframe it. A budget is not a financial diet. It's not about restriction. A budget is a spending plan. It's you telling your money where to go instead of wondering where it went. There's no perfect method. Zero based, 50, 30, 20. Those are some popular ones. The only right budget is the one that you'll actually follow, just like the only correct exercise is the one that you actually enjoy doing. Pay yourself first. This is the single greatest habit for building wealth, period. Most people get paid, pay their bills, spend on fun, and then save what's left. Pay yourself first flips the script. When you get paid, the very first bill you pay is to your future self. 10%, 15%, 25%, whatever it is, it goes directly to your savings and investment accounts on autopilot, and then you live on the rest. The habit matters more than the number. You're prioritizing your future, you're paying your most important employee, future you. Now, final term, financial freedom. This is the end game, but it's not what you think. Financial freedom is not being rich. It's not a specific number. It's control. It's having FU money, so to speak. It's the ability to make life decisions about your job, your health, where you live, without money being the single deciding factor. It's when your assets generate enough income to cover your liabilities and lifestyle. It's a point where work becomes a choice. That's the entire goal of learning this language. If you made it this far, you're already ahead of 90% of people. You just completed a half-hour financial masterclass. Now, these aren't just terms. These are tools. APR is a tool that can save you thousands on a loan. Compound interest is a tool to build your retirement. EBITDA is a tool to understand a business like a pro. You don't need a finance degree. You don't need an MBA. You just need to keep learning the language. Because when you understand the language, you can't be fooled. You see the game for what it is, you can finally start to play it. My question for you: drop a comment with the one term from this video that you never really understood until today. What was your aha moment? If you want me to do a deep dive on just investing or just real estate or just tax losing strategies, hit that subscribe button and let me know. We're on a mission to make financial literacy go viral.